Fibonacci numbers are a sequence of numbers characterized by the fact that every number after the first two numbers is the sum of the two preceding numbers. Although the sequence was described earlier in Indian mathematics, it was introduced to Western Europe by a man known as Leonardo of Pisa, also known as Fibonacci. The sequence goes as follows: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, and so on. Every number in the sequence is calculated by being the sum of the previous two numbers. 55 is the sum of 34 plus 21, and 13 is the sum of 8 plus 5. If you take any number in the sequence after the first few and divide it by the number that follows, you'll get 0.618. If you divide 21 by 34 or 55 by 89, the answer will be 0.618. If you take any number in the sequence after the first few and divide it by the number following the next number, you'll get 0.382. 13 divided by 34 or 55 divided by 144 both give answers of 0.382. And if you take any number in the sequence after the first few and divide it by the number two numbers further, you'll get 0.236. 13 divided by 55 and 55 divided by 233 both give answers of 0.236. These ratios, 0.618, 0.382, and 0.236, are known as Fibonacci retracement levels. They can be found when using the Fibonacci retracement tool available on many charting platforms. Although the 50% retracement is not an actual Fibonacci number, it is still observed by many traders. The Fibonacci extension levels are calculated by taking any number after the first few and dividing it by the previous number. 55 divided by 34 or 233 divided by 144 are both equal to 1.618. Fibonacci levels are often used by traders to identify potential levels of support and resistance. There are different Fibonacci tools, but we'll focus on the two most popular, retracements and extensions. Retracement levels can be identified by marking the swing high and swing low points of a given market. Fibonacci extensions can be identified using the same process. Here we have the swing high and swing low of the market. Shortly after the swing low point, the market moves higher and respects the 1.618 extension level. The reason Fibonacci levels work is because they are somewhat of a self-fulfilling prophecy. Institutional traders may look at these levels as potential areas of support and resistance, and in turn, many buy or sell orders are placed when the market is at these levels. I recommend using them in conjunction with other confluences to find high probability setups. They could also be used as areas for profit taking. Some traders use Fibonacci by looking for golden ratio setups. These are areas in the market where multiple swings all have a mutual area where Fibonacci extensions and retracements align. For example, this area here is the 50% retracement from this swing high to this swing low. The same area is also the 1.618 extension from this swing high here to this swing low. There could be multiple other Fibonacci extensions and retracements that align with this zone on different timeframes. Remember, there's no correct way to trade using Fibonacci ratios. You'll need to experiment with different ratios, either extensions or retracements, and find what works best for you.